In the basement of a Moscow bank, officials discover $200 million in untraceable cryptocurrency wallets. The money belongs to no one and everyone. Above ground, Western sanctions have supposedly cut Russia from the global financial system. Below ground, new trade routes emerge daily through digital networks, shell companies, and forgotten banking laws written in the 1970s. The sanctions were designed to isolate. Instead, they innovated. This is another video where money, power, and history collide, and nothing is ever as simple as it looks. When the United States and European Union announced sweeping economic sanctions against Russia in 2022, the narrative seemed straightforward. Cut access to SWIFT banking networks. Freeze central bank assets. Block major Russian banks from international transactions. Force economic isolation until political behavior changes. Sanctions work on paper the same way medieval sieges worked on parchment. You surround the enemy, cut off supplies, and wait for surrender. The theory assumes that economic pressure translates directly into political change. Modern sanctions promised surgical precision, the financial equivalent of smart bombs that would target oligarchs while sparing ordinary citizens. The public understood sanctions as digital walls, invisible barriers that would make Russian money disappear from the global economy. Banks would refuse Russian transactions. International businesses would cease operations. The ruble would collapse, and economic pain would force political recalculation. Reality proved far more complicated than the press releases suggested. Money, like water, finds cracks in every foundation. When Western banks closed their doors to Russian transactions, Russian businesses opened accounts in Dubai, Istanbul, and Hong Kong. When SWIFT networks blocked transfers, crypto exchanges processed payments in Bitcoin and Ethereum. When shipping companies refused to carry Russian goods, new logistics companies emerged overnight with Kazakhstani and Uzbek registrations. The global financial system resembles a vast spider web more than a simple highway. Cut one strand, and money travels along thousands of remaining connections. Sanctions assumed that Western financial institutions controlled all the roads. They controlled the major highways, but money learned to travel on back roads, dirt paths, and tunnels. Consider the mechanism by which modern black markets operate. A Russian energy company wants to sell oil to European buyers. Traditional banking channels are blocked. The oil company transfers ownership to a shell corporation registered in Kazakhstan. The Kazakhstani company sells oil to a Turkish trading firm. The Turkish firm processes payment through a UAE bank with correspondent relationships in London. The money travels through 7 jurisdictions and 4 currencies before reaching its destination. Each step appears legal within its specific jurisdiction. No single bank processes a sanctioned transaction. The system works like a relay race where each runner covers a legal distance, but the final result accomplishes what no individual runner could achieve alone. Technology accelerated this evolution. Cryptocurrency networks operate independently of traditional banking infrastructure. A Russian oligarch can convert rubles to Bitcoin in Moscow, transfer Bitcoin to a wallet in Singapore, and convert Bitcoin to dollars in Dubai. The entire transaction occurs without touching a single Western bank. Central Asian republics became financial bridges. Kazakhstan, Uzbekistan, and Georgia experienced sudden surges in banking deposits and international trade. Their banks maintained correspondent relationships with both Russian and Western financial institutions. Money could travel from Moscow to London with a brief stop in Almaty, transforming from sanctioned rubles to acceptable tenge to pristine dollars. The hawala system, an ancient Middle Eastern money transfer network based on trust rather than formal banking, experienced unexpected renaissance. Traders who had moved money across borders for centuries suddenly found their services in demand from sophisticated international businesses. A merchant in Istanbul could receive payment for Russian goods by collecting equivalent value from a completely different transaction in Mumbai. The Americans think they control money because they control banks, a Turkish gold trader explained to Reuters. They control banks. They don't control trade. Grey zone countries thrived. Nations that maintained relationships with both Russia and the West became essential intermediaries. Turkish banks processed Russian energy payments. Chinese manufacturers accepted Russian orders paid through Hong Kong subsidiaries. Indian refineries purchased Russian oil at discounted prices and sold refined products to European companies. The European Union discovered that sanctioning Russian oil while maintaining energy imports required creative interpretation. Russian crude became refined petroleum products of non-Russian origin after processing in Indian facilities. The same molecules flowed from Russian wells to European gas stations, but the paperwork transformed their identity. Financial services companies emerged specifically to navigate sanction restrictions. These firms specialized in transaction structuring, jurisdiction arbitrage, and regulatory compliance across multiple legal systems. They operated like financial travel agents, finding routes for money to reach its destination while avoiding prohibited territories. Private banking networks expanded rapidly. Wealthy individuals had always maintained accounts across multiple jurisdictions. Sanctions transformed this personal financial diversification into essential business infrastructure. A Russian businessman with accounts in Switzerland, Cyprus, and the Cayman Islands could continue international transactions by routing money through non-sanctioned entities. The cryptocurrency ecosystem exploded. Bitcoin mining operations relocated to Kazakhstan and other Central Asian countries. New exchanges appeared in jurisdictions with minimal regulatory oversight. Decentralized finance protocols enabled peer-to-peer transactions without traditional banking intermediaries. The technology that financial regulators had spent years trying to control became essential infrastructure for sanctions evasion. Traditional crime syndicates adapted their money laundering techniques for legitimate businesses. Methods developed to hide drug profits proved useful for hiding energy revenues. Criminal networks that had moved money across borders for decades found themselves serving Fortune 500 companies seeking sanctions compliance. Trade-based money laundering reached industrial scale. Over-invoicing became standard practice. A shipment of goods worth $1 million would carry invoices for $2 million. The extra $1 million represented disguised payment for sanctioned commodities. Import-export businesses proliferated in free trade zones where customs oversight remained minimal. The system created bizarre economic distortions. Gold prices surged in Istanbul as Russian buyers converted rubles to precious metals. Real estate markets in Dubai experienced massive price increases from Russian investment. Used car exports from Europe to Central Asia increased by 1,000% as vehicles became stores of value and currency transfer mechanisms. Banks faced impossible choices: comply with sanctions and lose business to competitors in non-sanctioning jurisdictions, process questionable transactions and risk massive regulatory penalties. The largest banks chose compliance. Smaller banks in peripheral markets chose opportunity. Enforcement proved nearly impossible. Western regulators could monitor transactions within their own banking systems. They could not monitor cash trades in Istanbul, cryptocurrency transfers through Asian exchanges, or barter arrangements between energy companies and manufacturing firms. The global financial system had become too complex and decentralized for comprehensive oversight. The sanctions succeeded in making Russian international transactions more expensive and complicated. They failed to prevent Russian international transactions. Businesses adapted by building redundancy into their financial infrastructure. Money moved slower and cost more to transfer, but money continued moving. Intelligence services found themselves tracking commodity flows rather than financial flows. When money becomes untraceable, investigators monitor the movement of physical goods. Satellite imagery showed Russian oil tankers with disabled tracking systems. Port records revealed unusual shipping patterns. The shadow economy became visible through logistics rather than banking. Black markets evolved from criminal enterprises to parallel financial systems. What began as sanctions evasion developed into permanent alternative infrastructure. Russian businesses built relationships with non-Western banks, cryptocurrency exchanges, and trade finance companies. These relationships would persist regardless of future political developments. The names have changed since the 1930s, when similar sanctions against fascist powers created similar workarounds through neutral countries and alternative payment systems. The behavior remains identical. Economic warfare generates economic innovation. Financial restrictions create financial alternatives. The more comprehensive the sanctions, the more comprehensive the evasion. Modern technology simply accelerated ancient patterns. Medieval Italian merchants used hawala networks to move money between Christian and Islamic territories. Renaissance bankers created complex trust structures to evade usury restrictions. 20th century businesses developed offshore financial centers to avoid tax obligations. Each generation develops new techniques to route around regulatory restrictions. Today's sanctions regime operates like yesterday's currency controls, trade restrictions, and capital flow limitations. Governments announce policies that sound comprehensive and effective. Markets develop workarounds that render policies partial and ineffective. The cat-and-mouse game continues with higher stakes and more sophisticated participants. The real winners are the intermediaries. Banks in non-sanctioning countries, cryptocurrency exchanges, trade finance companies, and logistics firms all profit from increased complexity in international transactions. Sanctions create profitable inefficiencies that benefit everyone except the original participants. The system reveals a fundamental truth about modern global finance. No single government or group of governments controls enough of the financial infrastructure to effectively isolate a major economy. Money has become too mobile, technology too decentralized, and the global economy too interconnected for old-fashioned economic warfare to achieve its intended results. The people who design sanctions understand international law. The people who evade sanctions understand international business. The gap between legal theory and commercial reality creates space for enormous creativity and enormous profits.